Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is real estate versus stocks. Where should you invest in 2025? Talking about the real estate versus stock market returns, which is the right for you. So as an investor, you have likely felt the impact of the recent market turbulence. In April 2025, equities lurched towards a technical bear market defined as a peak to through trough decline of 20% or more, as business policy uncertainty and unfavorable tariff news created the investors' sentiments. The S&P 500 and the most widely benchmarked index in the United States and around the world plunged 18.9 on a peak to trough closing basis in the roughly 2 months between Tuesday, February 19 and the Tuesday 8th of April, barely a percentage point shy of the bear market threshold. So public market have since tagged a rapid rebound, thanks in part to a 90-day stay on a 145% tariff rate with China. The S&P 500 opened the month of the June 2025 less than 4% from a new all-time high. But stock market investor may not be out of the woods yet. Absent further action, tariffs could resume on the July 2 to 8, meaning that investors may potentially have to brace for the additional volatility in the coming months. Besides, not all market recoveries are the rapid. At least historically speaking, it's common for a stock market investor to wait years and sometimes even a decade or more to regain losses after a significant downturn. Consider recent history 2022 to 2023. After a 25% decline between January and October 2022, the S&P 500 didn't regain an all-time high until January 2024. That meant investors spent 2 full years, 2022 and 2023, in a drawdown. 2000s. Even more dramatically, the S&P 500 returns essentially nothing in the decade plus between 2000 and 2013, thanks to the Byting.com. Employee of the 2000, 2003 and even sharper global financial crisis of the 2007 to 9. Experiencing these prolonged drawdowns can be stressful beyond the emotional toll. Spending years simply recovering losses means your capital isn't actively growing towards your long-term goals. It highlights a key challenge in the public market. Significant risk doesn't always guarantee commensurate returns, and the dramatic declines can be frequent visitors. So, what alternatives can you consider if you want to diversify away from public market volatility without sacrificing return potentials? So private real estate, a promising alternative for investors seeking to diversify away from the daily drama of the public markets. Private real estate could be potentially compelling alternative. So historically, private real estate has demonstrated lower volatility compared to stock market. That's because the valuation of the real estate and the private funds that own them tend to be more stable and change more slowly. This stands in sharp contrast to public traded assets, which tend to fluctuate dramatically based on news, sentiments, or the trading algorithms. Private real estate could be especially beneficial for portfolio diversification too. According to the Ares Wealth Management, private rental estate real estate had a 0.04 correlation to the S&P 500 index over the past 20 years and a negative correlation of 0.28 over the past 10 years. In short, this means that private real estate may perform well even in years where the stock market is struggling, when in turn suggests that allocating part of your portfolio to private real estate could help cushion the overall impact on your wealth. A closer look at the multifamily within a broader landscape of the private real estate. Multifamily properties could offer specific advantages that may be particularly attractive. Specifically, investing in private multifamily real estate funds which pool capital and invest in large baskets of loans. Multifamily properties could offer a different risk reward profile and the potentially more consistent return patterns like private real estate. In general, multifamily assets are typically valued using an income based approach. This means the more income a multifamily community produces, the more it's worth. Here's what sets multifamily apart is the resilience of the asset subclass. Rental income in the face of inflation. Specifically, residential rents have the outpaced broader inflation by a cumulative 26% since the beginning of the century. This historical tendency for rental to keep the pace with the exceeded inflation means that the income generated by the multifamily properties rises in tandem with the cost of living. This in turn could potentially drive continual increase in the property valuation and serve as a potential hedge against inflation for the multifamily investors. One advantage of investing in multifamily through a private real estate fund in particular is that your fund manager can, in certain cases, influence or exert direct control over the underlying deals. When making multifamily equity investments, fund managers can potentially participate in the acquisition, construction, renovation, management, and the disposition of the assets. These actions can directly impact rents and thus valuation, offering a pathway to the forced appreciation not typically available in the public markets. Similarly, multifamily debt funds managers can practice rigorous underwriting, leverage strong lending relationships, and use creative loan structuring techniques. These hands-on approaches, which aim at limiting loan losses and enhancing yield for the investors, can potentially result in higher risk-adjusted return for the investors in comparison to the more rigid and the standardized public fixed income markets. What's the takeaway? For the high net worth investors interested in the alternatives to the publicly traded assets, private multifamily real estate funds offer several compelling advantages. The first one is because multifamily real estate is priced using fundamentals rather than daily market sentiments. It tends to fluctuate less in value. This allows your capitals to potentially compound more consistently without the frequent need to recover from the deep losses. Multifamily real estate behaves differently from the stocks and publicly traded bonds. Adding private multifamily funds to your portfolio can potentially serve as a hedge against inflation and make it more resilient to the downturns, especially when public markets struggle like they did during the 20s. Private real estate funds managers can sometimes directly influence the underlying equity or credit investments they make. Skilled managers can potentially protect capital or the enhanced returns for the private real estate investors in a way that is difficult to replicate in the public markets. These advantages aside, private real estate funds can also potentially help you unlock unique advantages not available to stock market investors, including the depreciation 1031 exchanges or the payment priority in the form of the preferred returns. And these advantages aside, private real estate funds can also potentially help you unlock unique advantages not available to stock market investors, including the depreciation 1031 exchanges or the payment priority in the form of the preferred returns. This unique risk profile, coupled with an ability to counterbalance the public market swings, can make more private real estate a compelling alternative for the higher net worth investors. tired of the stock market roller coaster, consider private real estate investments fund from the DLP Capital today. So these are the FAQs, and which is better, equity or the real estate? Neither equities or real estate is objectively better since they feature difference in the liquidity, volatility, and the annual returns. So that was all about the topic where we discussed real estate versus stock market. Where should you invest in 2025? So hope this will have been beneficial for you. So do subscribe the channel for more videos. Thank you.